We will today discuss and review Chapter 7. The topic is how do financial institutions manage changes in market interest rates, and how does that result in an exposure or risks on their assets and liabilities on their balance sheet. As we spoke about in chapter number 1, a financial institution's assets are loans typically and securities, the two primary assets. The liabilities are borrowings as well as deposits for banks. In chapter 6, we briefly spoke about the risks that institutions face. One of the risks that we discussed was risks related to changes in market interest rates. Remember, it is not the financial institutions that decide on changes in market rates. These are decided by the central banks in each of the countries. Therefore, it will be up to the financial institutions to react to those changes in market interest rates and ensure the fact that their profits do not adversely get affected. In this chapter, we will discuss assets, particularly loans. We will discuss securities in chapter number 8 and 10. With respect to liabilities, in this chapter we will discuss deposits. One of the areas that we will not cover in this particular course, which is typically covered in a much more quantitative finance course, is with respect to duration gap management. The area that is responsible for this function in a financial institution is known as asset liability management. They are responsible for monitoring the portfolio of all loans and deposits and to ensure the fact that they are able to react to changes in market rates and change the portfolio of loans and deposits with respect to changes in market rates. We say the fact that institutions have control over assets, but they do not have any control over liabilities. What we mean by that is that assets being loans and securities, it is primarily up to the institution who they give loans to and how much they should increase the loan portfolio. Loans are given to individuals and businesses based upon their credit worthiness. So therefore, they can promote loans and securities if they want to increase their asset portfolio. If they don't want to increase their asset portfolio, they can price their loans higher, discouraging customers to apply at that institution for a loan. So they can control how much they want to grow or not. With respect to liabilities, particularly deposits, institutions cannot control that, mainly because it is up to the customer. If the customers want to deposit money in an institution, that institution cannot refuse the customer. If the customer wants to withdraw deposits, the institution cannot refuse that. So it is not necessarily at the control of the financial institutions when it comes to liabilities or deposits. In chapter 6, we defined net interest margin. We calculated that. Therefore, there are several pages in this particular chapter that we will not repeat or cover. Net interest margin, just to remind you, is the difference between interest income on loans and securities, which is exactly what we're talking about, loans and securities, and how we manage those. And the interest expense on liabilities, deposits, which is exactly what we're discussing now, is how do we manage the liabilities. The difference between interest income and interest expense is the net interest income. And when we divide that by the assets, we arrive at net interest margin. So this ratio is important to understand, to review that again. There are two different risks, essentially, that institutions face with regard to changes in interest rates. One is the price risk, the other one is the reinvestment risk. The price risk is relatively simple to understand in a sense that when interest rates rise, the prices of securities, such as a bond, will decline. So interest rates behave opposite of bond values. When interest rates decline, bond values will rise. And that is the price risk. So therefore, any investor, any institution, any corporation that has invested in securities, they need to be mindful of the market interest rates that could rise or fall subsequent to the time they invest in that security that is earning a fixed interest rate, which is a coupon interest rate. The reinvestment risk is one that is rather more difficult to understand. We have all studied at some point in time what is the meaning of yield to maturity. Yield to maturity is the aggregate, the return over time to maturity that an investor would receive on an investment. And that return includes the coupon interest rates that they will receive over time, which are again fixed. The reality is the fact that reinvestment risk occurs when the coupon interest rate that is earned is greater than the prevailing interest rate, which is the current market rate. What that means is that when an investor receives the return in terms of dollars on a particular investment, which is a coupon interest that they earn every 6 months, they must be able to reinvest those coupon interest rates at the same rate that they're earning on that existing bond. When rates have declined, obviously that is not going to happen, mainly because of the fact that the reinvestment rate will be lower, which is the market rate that anyone is willing to offer to them when they reinvest those deposits. And therefore, the reinvestment risk exists. In order to achieve the yield to maturity, which we believe we should be achieving in an investment, we must be able to reinvest those coupon interest payments that we receive periodically at the same interest rates that the bond is paying. We will exclude several pages next, mainly because these have been discussed in other courses, economics or foundation finance courses. We have, I'm sure, talked about loanable funds theory in an economics course, yield to maturity. In economics, the introductory course in microeconomics, we do talk about the supply and demand of money. So this will be excluded. Page 9 is also not required. Neither is page number 10. So these formulas for any of the slides that are excluded, students are not required to know these. Slide number 11 is also excluded. 12 is excluded as well, not required. as well as 13 is not required. So let's go to slide number 14. How are market interest rates determined? What drives market interest rates, which are, by the way, set by essentially the central bank? Market interest rates are a function of several factors. Some of these are potential risks. The interest rate is a function of 6 different components, all combined. The first of these components is the risk-free real rate of interest. What that means is that any investor who wants to invest in a security, any institution that wants to give out a loan, any other type of investments, the investor is asking for, at least at the minimum, a rate of return that is known as real rate of interest, which is the risk-free rate, which is equivalent to that investor depositing their money safely in a bank, earning a fixed interest rate. So in order for them to earn that risk-free rate, they could either invest or deposit their money in the bank, and if they choose to invest elsewhere, taking certain amount of risks that are not involved in bank deposits, then these are the risks that they should consider. And there are 5 different risks. Each one of these risks will result in an increase in the interest rate over and above what the bank is willing to pay on the deposits. One of the risks that we would add, which we call the risk premium, is default risk. What we're saying here is that if the investor wants to invest their funds elsewhere other than depositing the money in the bank, they will incur what is known as a default risk, whereby that security that they're investing in could become worthless. The corporation stocks or bonds they're investing in, that corporation could default, and therefore the investor will require a slightly higher interest rate than what he or she would earn depositing the money in the bank. And that factor is added, that percentage of interest is added to the risk-free rate. The inflation risk. Inflation means the fact that the longer the investment term, the higher the potential that inflation will go up in the future. The longer the security term, the higher the inflation risk, the higher the risk premium. Therefore, the amount of interest that the investor will be looking to earn will be slightly higher. Liquidity risk is the risk that the funds invested in any security other than bank deposits, those funds have to be left there for a certain period of time to earn the return, while deposits could likely be withdrawn from the bank if the customer wants those funds. Therefore, by investing funds in a security, that investor or that customer is incurring what is known as liquidity risk. They will not have access to those funds until that security matures. Core risk is risk associated with certain bonds issued by corporations and government agencies that are called back by those issuers, especially if interest rates decline. What that means is that these are called callable bonds. Therefore, an issuer who is a government or corporate who has issued the bonds when interest rates were higher is paying a high interest rate to the investors. if the interest rates decline subsequently, that issuer can call back the bond. That means they will pay back, give back the investor the funds that they've invested, and reissue those bonds at the now lower rates because the market rates have declined. And therefore, the risk exists for the investor, who would lose the higher return investment and may be forced to reinvest that at a lower interest rate. Therefore, the investor will be looking for a slightly higher interest rate initially, right up front, if that particular bond is a callable bond. And they will know that if it is a callable bond. So the risk exists for the investor, not the issuer. Maturity risk simply is the risk that that particular security will be worthless when that security expires. An example of this is General Motors Corporation, which had issued bonds in the 1960s, 70s, 80s, and 1990s. Many investors invested in GM bonds, assuming and expecting the corporation to exist. In 2008, during the financial crisis, General Motors failed. They filed bankruptcy, and all those bonds became worthless. And many of those bonds had not matured yet. So those individuals, those investors that invested in those bonds, while they were waiting for the bond to mature so they can get their investment back, did not receive anything. Formula number 7.4 is not essentially required by the students to know, mainly because all this formula is doing is reflecting these risk factors in the format of a formula. Page 16 will not be covered. I'm sure you have discussed yield curve, or you have studied yield curve in other classes. Neither page 17 is not required. 18 is not required as well. It is related to the yield curve as well. And so is page number 19. The net interest margin is not required since we studied that in chapter number 6. So starting with page number 15 up to page 20 are not required. Now we are on slide number 21. One of the risks, of course, that institutions face is, as I mentioned to you in the introduction, that interest rate risks results in exposure risks to the financial institutions on their assets and liabilities that they carry. In the textbook, on page number 228, this particular table is extremely important for all students to understand. This is the fundamentals of interest rate risk. One of the terms we're going to discuss here is what is known as repriceable, which is interest-sensitive assets, and repriceable interest-sensitive liabilities, compared to what do we mean by non-repriceable assets and liabilities. It's very important to understand that repriceable is the same as interest-sensitive. In order to explain this, let's suppose you have a bank. A bank has a loan. These loans are either fixed interest rate loans or variable rate interest rate loans. Example of fixed interest rate loans that are charged where the interest rate will not change for the customer throughout the term of the loan. These are typically automobile loans, but majority of the loans that are given out to customers, individuals and businesses, are variable rate loans. What that means is that the customer interest rate that the customer pays to the bank will rise or fall as interest rates go up and down. So those are known as variable rate. Most credit cards given out to customers are variable rate loans. All business loans are variable rate loans. And the reason why institutions and banks give out variable rate loans is because they want to protect themselves against rising interest rates. Therefore, if interest rates rise in the future, the customer will pay a higher interest to the bank, and the bank will earn a higher interest income as a result of that. A fixed interest rate loan, the rate is fixed. No matter what happens to interest rates, the bank will earn the same interest. Today, interest rates are at the lowest level, historically lowest level in the United States and elsewhere. The probability is that rates are going to go up, and therefore most institutions are giving out loans and investing in securities today whose interest rate is going to rise, and as rates rise in the future, they will earn a higher interest income. These are also known as repriceable. What that means is that when interest rates change on your loan or your credit card or your business loan, the loan interest will reprice. Reprice means it will change and will go up along with the market interest rates going up. If interest rates were to decline, yes, the interest rate on that loan or security will also decline. So that is what we mean by repriceable. Non-repriceable assets are those assets whose interest rate does not change, no matter what happens to market interest rates. Examples are fixed interest rate loans. We also have cash that the institution maintains. That's non-repriceable because this cash is kept for depositors. They do not invest that. So if they don't invest it, it doesn't matter what happens to interest rates. And other long-term securities, bonds, which pays a fixed interest coupon, interest rates are also non-repriceable. Buildings, equipment, machinery, furniture, all of those are fixed assets. They are not assets that earn interest. Therefore, these are not going to change, and the interest rate is not going to change on these at all. These are examples of interest-sensitive assets and interest-sensitive liabilities. Please remember the term repriceable and non-repriceable. On page 227, 228, the author explains these clearly. In the exam, you could be asked a multiple choice question where I could list 3 of these and 1 of these non-repriceable, and the student is required to identify which one of these 4 is non-repriceable. So it's just an example of how I would phrase the multiple choice questions. Let's look at liabilities. These are deposits and other borrowings that are interest sensitive. That means the bank is going to pay a higher interest rate on these deposits or loans that they have borrowed themselves as interest rates rise, and will pay a lower interest rates if interest rates decline. So the rate moves as market rate moves on these. That's why we call them repriceable. Examples of interest-sensitive or repriceable liabilities are those money market savings deposits whose interest rate varies with market rates, other short-term accounts whose interest rates are based upon variable rates, and also please note that banks borrow money from other banks. We studied that in chapter number 6, and those are called federal funds purchased. Those are overnight loans, if you recall from chapter 6. So again, these are repriceable. Non-repriceable liabilities are checking account deposits. We studied in chapter 6 again that most checking accounts that are typically business checking accounts, particularly the larger percentage of checking accounts and dollars are business checking accounts. And because business checking accounts do not earn interest, or where the bank does not have to pay interest, those are considered as non-interest bearing. Individuals do earn interest from the checking accounts, but those are very minor. Because they are categorized as under one demand deposits, which are checking account deposits, we will assume that they all are on a fixed interest rate basis, and therefore they are not interest sensitive. Long-term deposits, such as time deposits, certificate deposits, are also fixed interest rate until they mature, and capital, equity capital, is not a liability, and therefore that is not repriceable. So please ensure that you understand the difference between interest sensitive and non-interest sensitive, repriceable, non-repriceable, and likewise interest sensitive and non-interest sensitive liabilities. Next, these are the formulas that you are required to know. We will now discuss how does interest sensitive assets and liabilities affect what is known as interest sensitive gap. Please note that we will only focus in this course, since we are discussing those assets and liabilities that are sensitive to changes in interest rates, we will only focus on repriceable and repriceable, which is interest sensitive assets, and repriceable interest sensitive liabilities. These are not going to be discussed because interest rates do not affect, changes in interest rates do not affect these securities until they mature. In order to explain to you what interest sensitive gap means, we must first make sure we understand what are repriceable assets and repriceable liabilities. If the financial institution has equal amount of variable rate, which is interest sensitive or repriceable loans and securities on the balance sheet, equal to interest sensitive liabilities, deposits that are on a variable rate basis, if they are equal, the institution is known to have no interest sensitive gap. So the IS gap, which is the interest sensitive gap, will be 0. However, this is unlikely. No institution will have interest sensitive assets equal to interest sensitive liabilities. And the reason for that, as we discussed a little earlier, is that institutions do not have control over the liabilities. They can control the assets because they can decide how many loans, how much loans and securities they want to invest in. But the liabilities, deposits, are up to the customer. The customer must want to deposit money. A bank cannot force a customer to deposit money. So therefore, it is very unlikely that any institution will have the amount of assets and liabilities that are interest sensitive will be equal. So in other words, we will always have what is known as an interest sensitive gap. Interest sensitive gap is calculated by looking at all interest sensitive assets variable rate assets, repriceable assets, and subtract from that interest sensitive liabilities, which are repriceable liabilities. So we subtract the two since they are unlikely to be the same. Please note that we always subtract liabilities from assets, and the difference will be the dollar amount of interest sensitive gap. What I'd like to do next is display that and provide an example to the students. Let's suppose we have a balance sheet of, say, a bank. A bank has assets and liabilities that are IS is interest sensitive, means they are repriceable. We are only taking into consideration interest sensitive assets and liabilities. To keep the math simple, if the bank has $100 of assets which are considered loans that are going to reprice as interest rates go up and down, and they have $60 of liabilities, deposits, that are also going to reprice as rates go up and down. The IS gap, interest sensitive gap, is calculated by simply taking IS assets minus IS liabilities, and in this case it's a positive $40. This is known as a positive gap because the difference is positive. When a bank has a positive gap, the bank is also known to be asset sensitive. It's very important for students to know that a positive gap represents the difference between IS gap, IS assets and IS liabilities to be positive, and that is also known as asset sensitive. If that particular bank, let's suppose, has $60 of loans that are interest sensitive, $100 of deposits, therefore the gap will be assets minus liabilities always, and we have a negative gap. A negative gap represents that the bank is liability sensitive, means they have more liabilities compared to more assets over here. That's why this is an asset sensitive, because of a higher amount of assets compared to liabilities, and in this case it's just the opposite. Now, formula number 8 and 9 are required for all students to know. As we just defined, an asset-sensitive bank will have a positive gap where IS assets are greater than IS liabilities. Thereby, subtracting those two will result in a positive number. In our example, 40. A negative gap institution will have more assets, rather more liabilities that are going to, whose interest expense will change as rates change compared to assets, and therefore the difference is less than 0 or negative 40. And that is known as a negative gap bank. What does this mean? So let's take a look at the example that we just went through again. How is the institution exposed if interest rates change when that institution has a positive gap or a negative gap? In this case, if interest rates were to rise subsequently after these loans were given out and the deposits were received, by the bank. And remember, the interest rates are going to change in the future, and the effect of the change in interest rate is going to result in interest income or expense rising or falling. So let's suppose the fact that this particular bank has $100 of loans, and if interest rates rise by 1%, if interest rates increase by 1%, the bank will earn additional, which is incremental, interest income of $1, which is 100%, $100 rather, times 1%. So this is the additional interest, incremental interest income. Loans earn interest income, deposits pay interest expense to the customers. Please keep in mind, any interest that they're earning on the loan today is not factored in here. All we're looking for is the incremental amount, the additional interest income that the bank will earn as rates rise. On the other hand, deposits incur interest expense. If interest rates were to rise by 1%, they rise here, they could rise here by 1%. The bank will end up paying $0.60 additional cents of interest expense. Therefore, the difference between the additional interest income and the additional interest expense will be positive. What this means is that we simply take the interest income of $1 and we subtract from that the interest expense of 60 cents. And therefore, the net interest income will rise by 40 cents. So if interest rates are expected to rise, the net interest income will also go up. In this example, by 40 cents. Therefore, most institutions today you would expect most institutions today to have a positive gap, because interest rates are more likely to rise in the future than decline. And an increase in interest rate with a positive gap will result in a higher net interest income. However, if the institution has a positive gap, and if interest rates were to decline, go down instead, then net interest income will also decline. Because in that case, if interest rates were to go down by 1, instead of going up, they were to decline by 1%, the bank will earn $1 less interest because rates have declined. They're going to earn less money. However, if interest rates were to decline by 1% on the deposits, this bank will pay 60 cents less expense. Because rates have come down, the customer will earn less interest. The bank will pay less interest. If income declines by $1 and expense declines if income declines by $1 and if expense declines by 60 cents, we have a negative 1, minus minus will be a positive, and therefore the bank will experience 40 cents less income compared to 40 cents higher income. Therefore, if the rates were to decline and if the bank has a positive gap, that would result in a risk to the institution. Again, remember, we are only looking at those loans and deposits that are considered variable, means that those interest rates are going to change as market rates go up and down. Any fixed interest rate loans, such as automobile loans, are not included here, and neither are time deposits, which are fixed interest rate deposits. This is the example of a negative gap. If the loans are 60 and the deposits are 100, the bank is considered to have a negative gap. What happens if interest rates rise? If interest rates rise by 1%, this bank will earn additional interest income of 60 cents. However, there are more deposits where the bank is going to pay interest, and therefore, if interest rates were to rise by 1%, 1% of $100 deposits is equal to $1 interest expense. So we find that interest expense will go up by $1 while income will only go up by 60 cents. So the change in the net interest income, the incremental, similar to what we calculated here before, will be 60 cents positive income, and expense is $1. This is interest income minus interest expense. This is the incremental, resulting in lower income of 40 cents. Therefore, what this shows, that if any institution currently has more liabilities than assets that are going to reprice, given that market interest rates are more likely to rise in the future rather than declining, any institution that has a negative gap will experience a loss. And therefore, they must find a way to shift that portfolio whereby they will end up having more loans, assets, than liabilities that are repriceable. We will also in a little while go through an example of how we calculate these for an institution. So these equations are important to make sure that we know how to calculate positive and negative gap. On slide number 25, the author is showing their version of an example, which we just went through, our own. In this case, the author is saying that the institution has a negative 50 million gap. Means IS assets are less than IS liabilities. And this is known as a liability sensitive bank. The other equation that we must know is the relative IS gap. What this means is that we simply take the gap calculated. In this example, we have a negative 50 million gap, and we divide that by the total bank assets. What this means is that the actual result is a negative 0.33. Please note that this is not a percentage, since it is what is known as a relative gap. What this means is the fact that if interest rates were to rise and an institution has a negative gap, as we discussed a little while ago, an institution that has a negative gap, and if interest rates rise, will experience a loss, because the institution will end up paying a higher expense on deposits, because there are more liabilities, deposits, than loans. They will also earn higher amount of interest from the loans, but the dollar amount of interest expense will be greater than the dollar amount of interest income. And therefore, they will have a the change in the net interest income will be lower. Any institution that has a negative gap. And in this case, what the relative IS gap means is that this institution is exposed on 1/3 of their total portfolio, 50 out of 150 total assets. If interest rates were to rise, their balance sheet is exposed by 1/3. Now, what does that mean? Well, the institution has to decide that if that happens, can the institutions continue to survive with the relative gap being negative 0.33? What the institution must try to do is that if they expect interest rates to rise, they should try to minimize that. So a negative gap, a relative IS gap, is a risk to the institution if rates are expected to rise. And they should try to minimize that risk. The higher the relative IS gap, the higher the exposure, the risk to the institution if interest rates were to start rising. The other equation that all students must know is 711. In this case, we are simply dividing the interest-sensitive assets by the interest-sensitive liabilities, as opposed to subtracting the two. The IS gap is by taking 150 minus 200. The IS ratio is calculated by dividing the two. Now, what does this ratio really mean? What this means is that it's a different way of looking at it, arriving at the same result. If the IS ratio is exactly 1.0, that means the institution has equal amounts of IS assets and IS liabilities. And if I can go back to formula number 6, if these are equal, the IS ratio will be exactly 1. But as we discussed, that is unlikely for any institution to have that, because they cannot control the liabilities while they can control the assets. So every institution is going to have some ratio that is either more than 1.0 or less than 1.0. A ratio of less than 1.0, 0.75 in this example, is also going to result in the IS gap being negative, because the gap is going to be negative since IS assets are less than liabilities. So a ratio of less than 1.0 will imply a negative relative IS gap, and by the way, will also mean that the bank is liability sensitive. So liability sensitive institution will also have a negative relative IS gap and an IS ratio of less than 1. A relative IS ratio of more than 0.0 will imply a positive IS gap, and also an institution that is asset sensitive, whose IS assets are greater than IS liabilities. So I could ask you a question in multiple choice to make sure you are able to see the relative importance of all of these. That an asset sensitive institution will have a positive relative IS gap and will also have an IS ratio of 1.0 or higher. So let's look at the remaining part of the chapter before we go to the two examples and practice these. Why do net interest margin change? Why does an institution experience a change in net interest income? And what can the financial managers, financial institutions do to alleviate that? Well, they first need to make sure they have a forecast of what they expect the net interest income to be. They should have some sort of an idea as to what is the institution's appetite for net interest income. If they want net interest income to rise, they should manage their balance sheet accordingly. So they should have a target level of net interest margin. If they wish to increase net interest margin or net interest income, which is divided by net interest income divided by assets, is net interest margin, it must either develop a correct interest rate forecast, which is very difficult to do at times, or find a way to quickly reallocate their assets and liabilities to make the gap positive or negative. Also, they should look at the volume of those assets, loans, and those deposits that are sensitive to changes in interest rates. When we manage IS gap, we typically manage that not based upon total assets and total liabilities that are interest sensitive, which is exactly what we did before. In the example I showed you on my balance sheet a little while ago, we were looking at total IS assets and total IS liabilities. Well, the reality is the fact that the sensitivity of all of these assets that are interest sensitive and all of these liabilities that are interest sensitive is different depending upon what is the term. And therefore, we manage the IS gap by looking at the absolute term, the remaining number of days or months before these assets and these liabilities that are repriceable or interest sensitive are expected to mature. So we look at the portfolio and we break it down based upon how long are they going to be existing before rates change. We look at those loans whose interest rate is expected to change tomorrow, in one day. So the rate is going to be the same today, and if rates were to change tomorrow, it is going to affect these interest rates on these assets and liabilities. We also look at those loans and securities that are expected to expire, mature, and that will reprice because the rates will be different as soon as they mature over the next week. So this is from day after tomorrow, not tomorrow, this is one day, so this is day 2 to day 7. Incrementally, we look at next week, day 8 to the end of the month, assets and liabilities, 1 to 3 months, 3 months to 3 to 4 months, 4 to 6 months, 6 to 9 months. Please note that we only look at up to 1 year. The reason why we institutions only manage IS gap for those assets and liabilities that are expected to mature or expire up to the next 1 year, no longer than that, is because it is very difficult to forecast interest rates beyond 1 year. Yes, we can effectively forecast rates. Of course, we have been wrong in forecasting rates even for the short 1 year, but anything beyond that, it is very difficult to forecast rates and be accurate. Therefore, we limit our analysis in this chapter to only 1 year. We will look at an example at the end of the chapter by calculating the IS gap for each level of maturity. In this case, the author is showing that we have more assets than liabilities, so the gap is positive. We have more liabilities here than assets, so the gap is negative. So we simply calculate the IS gap for each maturity level, each line, and then we accumulate that. This is the accumulation of the gaps. What influences the net interest margin? So if you are a financial manager institution and you are determining what affects the institution's net interest income, net interest margin, and therefore the total profits, any change in interest rates is going to affect interest margin, because the interest rate earned and interest paid is going to change. The spread between yields and liability costs, what this means is the difference between interest earned on assets, what we call asset yields, and interest paid on liabilities, which is the cost, is the spread, is the difference. That difference, the change in that difference is going to affect the profit margin. How much assets and liabilities the institution has that are repriceable. So in number 3, we're talking about those assets that are going to reprice and those liabilities that are going to reprice as interest rates change. And also, finally, we also look at the change in the mix of assets and liabilities. The total assets, some of them are variable rate, which is what we're discussing. There are some assets that are fixed rate. They can look at the change and shift the variable to fixed, fixed to variable as interest rates forecasts exist. Page number 31 is not required. Here we are looking at essentially taking the actual calculation. We will go through the actual mathematical calculation for the effect on net interest income. Equation number 13 is required. Here we look at how we calculate the change in net interest income by simply looking at the gap times change in interest rate. Again, we will practice this later on, but this equation is required. One of the reasons why institutions manage interest-sensitive gap is they're trying to maintain the profitability level as interest rates go up and down. Therefore, if you were to apply this to current environment, if interest rates are expected to rise, which is what most institutions believe will happen in the future, most institutions are going to promote, give out to customers loans that are on variable rate basis rather than fixed interest rate. Why? Because as interest rates rise and the interest earned on these loans given out to customers will also go up, and therefore the bank will earn more interest income. However, when it comes to deposits, most institutions are going to promote fixed rate deposits, whereby the interest rate expense on deposit remains the same when rates rise, and therefore interest expense remains the same. So what that means is that if they position their balance sheet properly today, given rates are expected to rise, As interest rates rise, interest income will continue to go up because these are going to reprice, while interest expense on deposits will remain the same because they have promoted fixed interest rate deposits. And therefore, higher interest income in the future, same interest expense in the future will result in a greater profit margin. And therefore, net interest margin will rise. In the textbook, on page number 235, table 7.2, this is a nice summary of what we have already discussed. What happens when the institution has more assets than liabilities in terms of dollar amounts that are interest sensitive? They will have a positive gap. If the institution has a positive gap, what is the risk to the institution? If interest rates were to decline, that institution will experience a drop in income, a drop in interest margin. On the other hand, if the institution has a negative gap, where they have more liabilities than assets that are going to reprice when interest rates go up, the risk to the institution is that institution will have a lower net interest income if interest rates were to rise. Therefore, no institution today wants their balance sheet to be positioned with a negative gap, because if interest rates rise, they will lose money. They all want to make sure they have a positive gap. This column talks about what are some of the ways that the institution can fix things if they were to have a positive or negative gap. We will discuss these more in chapter number 8. Beginning with page 35, up to the end of the chapter, for the remaining slides, these are not required. These are on duration. Duration is a topic that we will not be discussing in this course. So the last slide that students must know is page number 34. In the syllabus, it is clearly stated which slides and the respective pages in the textbook are not required reading, and that includes starting with slide number 735 to the end of the chapter. That concludes the actual lecture part of the chapter number 7. What I'd like to do is spend the next few minutes discussing the two problems and going over the two problems that are assigned at the end of the chapter. And I will be using the visualizer, the document camera, to illustrate that. There are two problems that are assigned at the end of chapter. These are problems number 7, rather problem number 8 and 9, chapter number 7, page 249 in my textbook. I will first display the problem that is in the textbook. First, problem number 8. In this particular problem, we have the First National Bank. They provided us with the assets and liabilities portfolio of the First National Bank. And this shows the interest-sensitive assets only and the interest-sensitive liabilities by category. They also reflect the actual maturity of these. That means that these loans and securities and these deposits will expire in the next 7 days, beyond 7 days up to 30 days. So these are not included in here, please. These are additional. From day 31 to day 90 and any term beyond 90 days to 1 year. We only go up to 1 year, please, as we talked about, because institutions can only forecast effectively interest rates up to 1 year. So these are from 1 day to 1 year. These are the assets and liabilities that are expected to expire, mature. Please note that these are all sensitive to interest rate changes. The question is, we first need to calculate the gap. And then we are asked to determine when and by how much is the bank exposed to interest rate risk. We are not asked to calculate anything. Under which maturity bucket the bank will experience a decline in interest rates, rather a decline in interest income, or a rise in interest income if interest rates were to go up and down. For each maturity or repricing interval, these are repricing intervals, maturities, what changes in interest rate will result in the institution benefiting or have a damaging effect, means it will be detrimental. So the benefit means the fact that their net interest income will rise. Damaging means net interest income will decline, given the portfolio position. So what we have here is an example. What we have here are loans and securities, what's given to us in the problem, those that will mature in 1 week, 30 days, 1 month, or 3 months, and beyond 3 months. What we first do is add up all the interest-sensitive assets. So the institution has $221 million of those loans and securities that will expire in 1 week. Means the interest rate will change when they expire, because they are all interest sensitive. These are loans and securities that are expected to expire or mature in next 30 days, beyond 1 week to the end of the month. In the next 31 to 90 days, and more than 90 days up to 1 year. These are the liabilities, deposits, which will expire and reprice if interest rates were to change at each level of maturity. We first need to calculate the IS gap. IS gap is the difference between IS assets and IS liabilities. We always subtract liabilities from assets, and therefore in this case the IS gap is a negative 335. By simply taking 221, we subtract the liabilities, 556, results in a negative gap. The same thing happens in the next bucket. IS assets are less than IS liabilities. But for the next 2 buckets, we find that the assets are greater than liabilities, and therefore we have a positive gap. What we are required to do for each maturity bucket for each one of these gaps, we are required to determine if interest rates were to rise or if interest rates were to decline in the future, whether it will be beneficial to the bank or would it be damaging to the bank, meaning the fact that will the bank earn higher net interest income or lower net interest income. If the bank is going to earn higher net interest income, it will be beneficial, and if they are expected to earn lower net interest income, it will be damaging. So let's take a look at the first one. If the gap is negative, will it, if interest rates were to rise, will the bank experience a positive or negative change in net interest income? We will go through an example next. If interest rates were to rise, say by 1%, that means interest income will rise by $2.21. Which is 1% of 221. If interest rates were to rise by 1% on the liabilities, interest expense will go up by 556. So as interest rates rise, for example, by 1% in both cases, interest income will rise less than expense. Remember, both of them will go up as rates are rising. But because there are more liabilities where the bank pays expense, expense is going to rise more than income. They both will go up. And therefore, the net interest income, which is the difference between the additional income and the additional expense, will be negative. And that would be $3.35. The bank will experience a negative $3.35 of net interest income. And therefore, it will be damaging to the bank. So if interest rates rise, the bank will suffer because their incremental net interest income will decline. When we look at the next bucket, the same will happen, mainly because we have less assets than liabilities that are going to reprice. So any time we have a negative gap, if interest rates were to rise, the bank's net interest income will decline. Now, there was a formula number 13 that we studied in the textbook, and I'm going to bring that back up, please. This equation shows a much more simpler way to calculate the result that we just calculated for the example. We can simply take the gap, the cumulative gap, and multiply that by the overall change in the interest rate. Let's do that. So in this example, we first calculated increase in net interest income and an increase in net interest expense, and we subtracted the two. We can arrive at the same result, negative 3.35, which is the difference between the additional income and the additional expense, by simply taking the gap and multiplying that by the change in interest rate. So if we look at the gap of 335 negative, which is the IS gap, and we multiply that by interest rate change. In this case, interest rates are rising. So therefore, if rates are rising, we multiply that by positive. If rates are declining, we will multiply that by negative. When we calculate this, negative 335 multiplied by positive 1, mathematically will result in negative 335. So we notice the fact that we come back to the same result as we did before by simply doing one mathematical calculation. As long as interest rates change at the same rate, we can use this formula. In this case, a negative gap of 104. If interest rates were to rise by 1%, will result in 1.04 net interest income decline. So therefore, it will be damaging. When we have a positive gap, if interest rates were to rise, this will benefit the bank. Just the opposite. Why? Because if we have a positive gap of 219, and if interest rates were to rise by 1%, means they go up by 1% plus 1, this would result in a positive change in net interest income. Two positives multiplied results in a positive. So that means the fact that the bank will benefit, net interest income will rise. And the same will happen in this case. Because the bank has a positive gap. What we're going to do next is go through that exercise one more time by looking at the cumulative gap. A cumulative gap is essentially accumulating the gap for each of the buckets. So in this case, the gap is negative 335. When we combine these, the next two, up to 30 days, the gap is now 439, which is 335 and 104 combined. They're both negative, results in a negative 439. Now we are including a positive 219 gap. Negative 439 and a positive 219 combined will now be a negative 220. And now with the negative 220 gap, when we combine a positive 430, the overall gap is positive 210. So this is simply an accumulation of the four maturity amounts. So again, if interest rates were to rise, being a negative gap, net interest income will decline. It will be damaging. If interest rates were to rise and they have a negative gap, of course, that would result in a lower net interest income. Again, here we have a cumulative gap of a negative 220. It was positive 219 for the bucket, but now on a cumulative basis, the gap is negative. If interest rates were to rise, net interest income will decline. The only time the net interest income will rise is when we look at the total portfolio, which is a positive gap. A positive gap will result in higher net interest income if interest rates were to rise. So please remember the fact that a negative gap will result in lower or damaging effect on the institution if rates were to rise. A positive gap will have a positive effect, will benefit the institution if interest rates were to rise. Let's look at what happens if rates were to decline on the other end. If rates were to decline and the institution has a negative gap, it will be beneficial. Let's calculate this. So now we have a cumulative gap of 335 negative. If interest rates were to decline, say by 1%, we multiply that by 1%. We are multiplying this by -1, not a positive one, because rates are now expected to decline. When we multiply the two negatives make positive mathematically. And therefore, net interest income will rise by 335 compared to declining. They would decline if interest rates were to rise. The net interest income will increase if rates were to decline. And therefore, that's the benefit to the bank. Anytime the result is a positive NII, it's beneficial. Anytime it is negative NII, it's damaging. When we do the same calculation here, because the gap is now 439, with a decline in interest rate by 1%, the bank will experience a positive NII. This is simply taking 439 times negative 1%. Decline in interest rate will be plus 439. Same thing will happen here with a negative gap, with a decline in interest rate that would result in a benefit. The only time it will be damaging when we look at the total. In this case, we have a positive gap of 210 compared to negative before. When interest rates were to decline by 1%, means they go down, and we multiply that by -1, positive and negative will result in a negative net interest income. So therefore, it will be damaging. So this gives us an idea of how the effect of a positive and negative gap will have on the institution if future interest rates were to increase or if future interest rates were to decline. Let's look at number 9 next. So first I'm going to display the problem. In problem number 9, we have a bank currently has the following interest sensitive assets and liabilities. So again, please note that these are all interest sensitive assets and liabilities with these amounts. That's the total amount. Here we are not looking at the actual maturity buckets, but for the whole bank. So this is the total bank's combined assets and liabilities that are going to reprice. The author introduces an additional concept here that we haven't spoken about this in the chapter yet, which we will discuss next. What is known as the rate sensitivity index. So each one of the assets and liabilities have their respective index, which we call rate sensitivity index. How sensitive is the changes in interest rates on these specific loan assets and liabilities? We are required to calculate what is the bank's interest sensitive gap. And we will also calculate the IS gap adjusting for the various sensitivity index that are given to us. Once we calculate that, the author is asking us now to determine what if interest rates rise by 50 basis points. That means, by the way, that's 0.5%. There's a 0.5% increase in rates or a 0.5% decrease in interest rate. So to do that, so these are the assets and liabilities. Please note they are interest sensitive, so they are going to reprice with changes in interest rates. We have federal fund loans. These are loans that banks provide to each other. So one bank has given a loan to another bank, so this bank is going to reflect that as an asset. Instead of giving loans to customers, they have given loans to a bank. They also have other loans that are given to customers and leases. And they also have invested in securities whose interest rate that they earn varies with changes in interest rates. Each one of them have a respective sensitivity index. Then we have interest-bearing deposits. Interest-bearing means those deposits where the bank is paying interest, and also money market savings, which are variable rate deposits as well, and their respective index. The total amount of the assets is 450. Total of liabilities is 340. So first we're going to calculate the gap without taking into effect the index. Once we calculate the gap and the effect of changes in interest rates on the absolute gap, we will then move on and redo the calculation, take into consideration the rate sensitivity index. So let's practice this plus. Here we have a 450 IS gap, IS assets, 340 IS liabilities. Therefore, the gap unadjusted for any index is simply 450 minus 340. That's a positive 110. When we have a positive gap of 110, the author is asking us to calculate the change in the net interest income if interest rate change by 0.5%, which is 50 basis points. So if interest rates were to increase or decrease by 0.5%, what will be the effect on the net interest income? Will net interest income rise or fall? We simply use the formula 713 in the textbook that we looked at. With a positive gap of 110, if interest rates were to rise or increase by 0.5%, because rates are increasing, we will multiply this by a positive change in interest rate. 0.5, please, should be 0.005 as a fraction. This is very important to convert the rate into a fraction. Students must not multiply that by 0.5. That would be incorrect, and no points will be given to the students in the exam if they do that. When we multiply 110 times positive change in interest rates of 0.005, the result will be a positive increase in net interest income. And therefore, this will be beneficial to the bank. So if a bank has a positive gap, if interest rates were to rise, net interest income will rise as well. If rates were to decline by 0.5%, on the other hand, we calculate the effect on net interest income. We have a positive gap of 110, but because interest rates are declining, we multiply that by a negative 0.005 rather than a positive, and therefore a positive times a negative will result in a decrease in net interest income. So this allows us to practice the effect on net interest income incrementally. This is just a change. This is not the total income, net interest income. This is just the effect of the change in interest rates by 0.5% going up or down when the institution has a positive gap. Next, we're going to look at the sensitivity index. First, I'd like to define and explain to you what this index means. We will then adjust the assets and liabilities by simply multiplying those by the index mathematically and arrive at the index adjusted dollar amount, and then take the difference to arrive at the gap again. Now, what does this index mean? The rate sensitivity index is essentially discussing the exposure, the relative exposure to the institution if interest rates were to rise or fall. What we are saying here is that all along we've been assuming the fact that interest rates, when interest rates change, they change on the whole portfolio. Well, the reality is the fact that the risk of change in interest rate is different depending upon the types of loans, securities, and the type of deposits they have. What we mean by that is Fed fund loans. These are loans given to other banks. Those loans expire the next day. They are structured in the way that these loans are only what we call overnight loans. So therefore, these $50 million of assets, federal fund loans, that one bank has given to another bank, those loans will not be affected at all no matter what happens to interest rates tomorrow. Rates could go up and down at whatever rate they want to. No effect will be on this because of the fact that they will expire. And therefore, the exposure index, the sensitivity index, is 1.0. When we multiply that 50 by 1.0, the adjusted dollar amount is 50. The reason for that is because it doesn't matter what happens to interest rates tomorrow, even though they are interest sensitive, these loans will expire and will have no impact at all on the bank's net interest income. Of course, the bank can re-lend that money, give that money to another bank tomorrow, and the rate will be different. But it will then expire the next day. However, when we look at loans and leases, I'm going to come back to securities in a minute, compared to Fed funds, these loans and leases have a much longer term exposure because they do not expire tomorrow, as is the case with the Fed funds. These loans and leases expire in 1 week, 1 month, 3 months, 6 months, 9 months, up to 1 year. So therefore, that institution has a greater exposure on that for up to 1 year rather than one night. These are only for 1 day. These are for up to 1 year. So their exposure, if rates were to go up or down, will be longer. And therefore, the index is higher. The higher the index, the greater the exposure because of the long-term nature of these interest-sensitive loans up to 1 year compared to 1 day. So the index is significantly higher. So you may ask, why is the index less for security holdings than loans. And why is it higher than Fed funds? First, the security holdings have a higher index, so they are more sensitive than Fed funds because they do not expire tomorrow. These securities are there for the longer term, up to 1 year. So they could price any time between now and 1 year, compared to Fed funds, which they will not reprice because they're going to expire tomorrow. However, the security holdings have an insensitivity index of less than loans. The reason for that is because the exposure, if rates were to go up or down on securities compared to these loans, is less. Why are securities less exposed to changes in interest rates? Is because the institution can sell these securities on the secondary market. In other words, if I have a bond, a security, a bond, if interest rates were to rise, I can minimize my loss by quickly selling that in the market before rates even go higher. The higher the rates go, the lower the value of my bond. So I can sell that and reduce my risk, my exposure, my losses by selling them. However, loans and leases cannot be sold. Once the bank has them, they are required to keep them. They cannot sell them. But securities can be sold, and therefore resulting in a lower exposure to the bank. And that's why the exposure is less, the index is less than the loans. When we multiply the relative index times the amount of the loan of the assets, we arrive at the index adjusted assets. We then add them up. The reason why the index adjusted total IS assets is higher than unadjusted is because we have significant amount of assets that have an index of 1.0 or of higher than 1.0, and therefore these amounts are higher than that. We will do the same thing with liabilities. We have liabilities that are interest sensitive, whose interest rate is going to change. These are deposits, where the bank is going to pay interest. Why is the index less than 1 for deposits compared to loans and securities? The reason why the sensitivity is less than 1 means they are relatively less sensitive if rates were to go up and down compared to loans. They're relatively less sensitive because the index is less than 1. It's because typically what happens, and the answer to that question is essentially also exposure. When interest rates rise, institutions are required by law to increase interest on these loans. They must increase interest on your loans immediately. So if you have a credit card which is on a variable rate basis, which is probably what you have today, as soon as the central banks raise interest rates, your credit card rate is going to go up that same minute. The institutions will go into the system and change the interest rate on all credit, all loans, and because they are required to do that. Therefore, their sensitivity index is high, more than 1. However, banks are not required by law to increase the interest rates on deposits just because interest rates went up. And therefore, most all banks will wait or delay increasing interest rates as interest rates rise on deposits. They will keep the rates the same, while loan rates are going to rise immediately. Because interest rates are not going to rise as interest rates change, the bank is not exposed as much on the deposits as they are on the loans. and therefore the sensitivity index is less than 1. Research shows, by the way, to explain this to you further, research shows that when interest rates rise, banks will raise interest rates. If interest rates rise by 1% on average, banks will raise interest rates by 1% on all of these loans and securities, earnings on securities. However, banks will raise interest rates by only 0.5% on deposits. Means they will delay increasing rates on deposits because that results in an expense. Loans provide income, liabilities incur expenses. So banks will raise interest rates on deposits by only half when rates go up on loans by 1%. And therefore, the index is less than 1. And the same thing happens with all deposits. What we typically find, according to research, is that banks will keep the interest rates on deposits the same while rates are rising. And eventually, the bank is going to experience a decline in deposits as customers withdraw the money and invest elsewhere, because banks are not raising interest rates while rates have gone up on all other investments in a rising rate environment. So customers will eventually withdraw the money, and once that happens, the bank will begin to raise interest rates as a defensive tool to prevent more and more deposits leaving the bank. And therefore, eventually the banks will raise interest rates, but they will do that much later than rates going up on loans. What we do is we multiply the index, being a lesser sensitivity, because banks delay raising rates. We find the fact that the calculation shows that adjusted for the index, the actual deposits, interest-sensitive liabilities, are less than unadjusted. We then subtract the two to arrive at the gap. Part D. The actual IS gap adjusted for the index is simply subtracting 617.5 we subtract 617.5 and 273. The gap is a positive 344. Please note that the gap is higher than unadjusted because of the higher index we have on the loans compared to deposits. We now calculate the effect on this adjusted gap of 344.5 if interest rates were to increase by 0.5% or decrease by 0.5%. So we simply bring in the gap here. We have a positive gap of 344.5. If interest rate increase, we multiply that by a positive 0.005. So please make sure we convert this to a fraction. Two positives make the result is positive, and therefore the bank will experience an increase in net interest income incrementally if rates were to rise. On the other hand, if rates were to decline by 0.5%, we will multiply a negative, because the rates have gone down, times a positive. A negative and a positive results in a decline in interest rate, or minus 1.72. So with a positive gap, a rise in interest rates increases net interest income. A decline in interest rates results in a decrease in net interest income. direct impact. Positive gap, higher NII if rates rise, lower NII if rates decline. So that concludes the second problem at the end of the chapter number 7. And that essentially concludes the chapter itself.